So today's topic is going to be on stock warrants, and I just want to give a quick shout out to Hawaii 808. He actually suggested this video, um, so I'm always down for some recommendations. Just leave a comment on a video that you want me to make or look into. I really appreciate it actually because it helps me learn and it's pretty fun for me to make. So as always, if you guys like these videos, if you could just throw me a like or subscribe, that'd be awesome. It's really cool to see those numbers go up, and I'm almost to 50 subscribers, which to me is a big deal. That's the goal by the end of the week is to hit 50. So yeah. Also, there's some links to some free stocks in the description, and let's get into it. Okay, so I'll try to get through this as simply and quickly as possible. I know long videos can get boring, so as always, I will just leave the links in the description if you want to do some more in-depth research. I'm just going to go over the benefits, the risks, and what these are, and hopefully that helps you guys understand these better. This is the ticker symbol plus W, so for example, FMCIW. A stock warrant is a financial contract between a company and investors that give the investor the option to purchase the company's stock at a specific price by a specific date. In this case, it's 5 years, as you can see, but I've read it can be up to 15 years. This is established before you buy the warrant. A stock warrant allows the holder to receive newly issued stock from the same company that provided the warrant, which will increase the outstanding shares because it's new stock. A company might issue stock warrants simply to attract more investors. For a company, a warrant is a source of potential capital in the future, when it is looking to raise additional capital without offering bonds or stocks. So you'll often see this with mergers or bankrupt companies that are trying to recover. So a warrant doesn't equal immediate ownership in the company like a share would. Only the right to purchase the company shares at a particular price in the future.
There are two types of warrants, a call warrant and a put warrant. A call warrant is the right to buy a share at a certain price in the future, and a put warrant is the right to sell back shares at a specific price in the future.
Here are the similarities and differences between warrants and options. Options are issued by another investor who holds at least 100 shares of the stock, which would be one contract. You pay the shareholder a premium, so he or she is profiting from selling the contract to you. Warrants are issued by the company, increasing their total outstanding shares, so similarly, they are raising money. The benefit to warrants is you don't have to buy 100 shares, you buy as much as you want. So for smaller investors, covering the collateral of 100 shares for a contract in call or puts, whatever, you have to cover the collateral, which can take your buying power. You have to have at least that much buying power, and that can get expensive for companies that are like Tesla. Trying to buy a call for them can cost around $3,000 in collateral. So warrants are cheaper, and you get more shares for the same price. They have a longer lifespan, so it's a nice risk and time scale balance, and it gives you more time to prove your hunch, whether you think it's going to go up or down. Warrants can be bought and sold up until they expire. So if a current stock price is below the strike price, the warrant may still have some time and value and can therefore be sold for something. Just because the stock starts trading above the strike price doesn't mean you necessarily have to exercise selling the warrants right away. If you see a lot more potential, you can hold on to it just like with a normal stock. Just because Tesla hits 1,000 doesn't mean you have to sell it off. It has potential to go to 2,000, whatever. So there's more profit. If you see more profit potential, then hold on to it. And if you think, I hit what I wanted to hit, you can sell the warrants. And it took me a little while to understand it as well. So just bear with me, and I'll try to explain it best I can. So the stock warrant, let's say it's trading at $4 with an option to exercise an $11.50 per share fee to convert it to one share of FMCI. So the warrant plus the fee equals right around what the stock is trading at today. And that warrant price will go up depending on how the stock's doing. So they typically mirror each other if you add that fee in. So they're very close in price, but you're paying less now, which offers a higher percent return than if you had bought shares directly, because you can buy more of them. So this also limits your risk because you don't have to pay that fee. If they expire out of the money, they're worthless. So it's less of a risk, but it's more potential for profit. So if you believe the stock plus the fee will be over the cost of your investment, then it's a good investment. So you don't even have to pay that fee. You can sell your warrants off in the money and make a profit. So that's why this is a really cool thing. Okay, so here's an example that I drew up. Let's just say you have $1,000 in buying power, and to keep it simple, I used whole numbers. So let's just say one share of FMCI is going for $15. You could get around 66 shares for $1,000. Or let's say one warrant's going for $4, you could get 250 warrants. So let's say the stock jumps to $20 from $15 before the expiration date in 2025. Your stock profit would be around $330, and that's great. Never expires, almost no risk, except for what the company does. There's no expiration, no nothing. Your warrant profit plus conversion fee would profit you $1,125 with the same $1,000 investment. But these could expire. There's more risk, but there's also a lot more reward. Or you could sell your warrants similar to options. So here's a little example I found on the internet below. You can sell them similar to options. Let's say the stock is trading at $50 and the strike of the warrant is $40. The warrant should trade for at least $10, assuming one warrant equals one share. This is because someone could buy the stock at $40 with the warrant and sell it immediately for $50, a $10 profit per share. Some main takeaways. So risks. Warrants can be more volatile and have more extreme risks than regular stock. For instance, a 20% drop for regular stock would be about a 60% drop in warrants. They can expire worthless and out of the money. Disadvantages of warrants. They do have higher drawbacks and risks because they obviously have more profit potential. So that goes hand in hand. Because there's such high leverage, it's a great thing, but it can also go against you the same way. So definitely do your own research on that and only invest what you're willing to lose. Because, although I believe it's better than options because you have a lot longer to be right about your investment, only do it with a company you truly believe in, you really like their business model and you see a huge potential. Let's go over the benefits. More profit potential, great for small investors who don't have a lot of buying power, doesn't expire as quickly as options, and if you believe in the company, it would be a great way to build your portfolio. Lastly, I just want to say thank you guys for watching. Please like and subscribe. This video did take me a while because I'm still learning about warrants myself. So this took a lot of research, and I feel like I finally understand it. I know it can be a really confusing topic, and I think that's why there's a lack of videos on YouTube and explanations of it. But I hope this helped you a little bit. I know it can be confusing, so please don't roast me in the comments. I hope this gave you a little bit of insight on what warrants are. So thanks for watching. There's some free stocks in the description if you haven't signed up for Robinhood or Webull. And have a good one, guys.